Hello, Circle of Nine community. Today is going to be part 2 of the turtle soup lecture. Previously, we mentioned the ingredients that are necessary for a turtle soup and that create that higher probability scenario for a reversal. And then in this lecture, we're going to actually portray that with a couple of very basic models. We're going to talk about the PD arrays of choice that we're going to observe. And then we're going to look for that same process, those same steps as we talked about in the previous lecture: time, SMT, and the anatomy of price. So even more so, in this lecture, we're going to observe how price develops, where to place your stops, and what you can possibly target, especially if you're doing a higher time frame swing trade. So one of the most basic, and you probably see this all the time now, and it's very common knowledge, and it's nothing really special. What makes this even more higher probability is the aspect of time, especially if you have a time model confluence, as we talked about in previous lectures. So let's say you see a V-shaped recovery for Aries time model, and it takes out an external high or low, range-based liquidity. Then you know exact timing what's going to happen. However, this is pretty, how do I put this plainly? This is very basic. You're essentially just looking at range-based liquidity. So zoom out on the chart, and we're going to portray that in a few examples. But this template here on this slide portrays that. Look for an external high, external low. And when that external high or low gets purged, the liquidity and stops above or below that external high or low gets purged and taken out. Retail traders are stopped out. What are you going to look for? What did we talk about in the previous lecture? You're going to look for an SMT. You're going to look for the right timing. Then you're going to observe the root candle and try to get into that premium or discount, targeting buy side or sell side, depending on where price is. And from there, you can place your stop accordingly, which we will talk about. But the most important PD arrays are going to be range-based. So your external highs or lows. We talked about open, high, low, close in the previous lecture, that concept, how a candle forms. That can also be a possible high or low. So let's say you are trading the daily bias, and your bias for the next day is a bearish bias because the current day candle closed beneath the previous candle 50% of the body. So now for tomorrow, you're expecting a bearish day. So what can you do? Well, you use today's daily candle, the open, high, low, close. And if you're trying to target sell side because your bias is bearish, then you're going to enter above the close, at the very least, of the bearish candle. If not, then 50% of the body. And we'll show a couple of examples of that. Then equal highs or lows, those are often SMT potential scenarios as well. Include the aspect of time, and it becomes really easy. Another very basic turtle soup type of entry is when you see a higher time frame fair value gap. Now, what makes it a turtle soup is you're entering at the top, essentially. You don't have to do that. This lecture will teach you how, but you don't have to get the absolute top or bottom. Think about it in terms of the fractal nature of price. Let's say you're trying to long a 5-minute fair value gap, a BISI. You'll probably just long it and look for an entry in that fair value gap so you can target buy side, right? You won't think much of it. You're not going to observe the lower time frames, really, the 30-second time frame. But most likely, if you go to the 30-second time frame, there is occasionally going to be an SMT. So price, just like time, is very fractal. So someone can normally just short a higher time frame fair value gap. In this case, in this example right here on the slide, it can proceed back up to that higher time frame fair value gap, maybe on the 4-hour daily chart, and a trader can simply short it and not think that it's a turtle soup type of entry, and they can get sell side and get a pretty great return or move, right? But if you want to technically get the top and call it turtle soup, it's just a market reversal, then you can. And the entry for that is the same as the previous example. Instead of a external higher low, which is range-based liquidity, as a PD array that you're going to observe, you're now observing the inefficiency in the market. So there's a lot of orders that were left up there. So now price is proceeding back up in the example on the slide. And those orders are looking to get filled. There was an inefficiency there. Then look for an SMT, look for the right time, and then focus on the open, high, low, close anatomy of price. That is simply it for these two templates. And you can also use this for a continuation towards buy side. So it's very basic. But we're going to observe a couple of actual chart scenarios next. In this first example, we're going to be observing crypto because this type of price action occurs in every single market. These type of reversals, institutions are trading all of these in most cases, and we can simply use the aspects of time and price to get an amazing entry towards our bias. So let's say you're observing a higher time frame PD array. Right here, we're at all-time highs for Bitcoin. Now, this high over here gets formed. We take that high out, then this is the subsequent high after that, right here. Now, what are we going to do? Well, as we're proceeding towards buy side, we're going to observe the candles and the highs. And we're going to draw it on both ends, the same time frame, Ethereum and Bitcoin, as they're aligned with each other. And we're going to observe both. So if you're looking to possibly short, you can do this to long as well and continue the trend and nab a turtle soup entry. But if you're looking to short, then this is where you're going to observe. Now, notice the timing right at midnight. Bitcoin takes that high. Ethereum does not. Right there, right? So there's your SMT. Now that we observed that SMT, we're going to next observe. I'm going to just go back a little bit. The lower time frame, because we're observing the 4-hour, and what we observed on the 4-hour was a high got taken out for Bitcoin. Ethereum failed to take that high. It's a very obvious SMT. So which one are you going to trade at that point? Before I go to the anatomy of price, quick question: which one are you going to want to trade? Which one's going to have the more volatile move? Bitcoin, because that's the one that took the high out. This one over here, Ethereum, is weaker. So it's not going to have as great of an entry compared to Bitcoin. Okay? But notice the 4-hour candle right here. Notice it closed beneath the high and it could not close above it. Then what happened at that time was there was an SMT. When that SMT occurs, you're going to observe the timing of it, And then you're going to observe what price is doing thereafter. So let's go to the 15-minute chart on both. So that high got taken out at midnight and then again at 3 a.m. There's another SMT right there. Between this high and this high, Ethereum did not make another high. So there's another more prominent SMT right there. Now let's zoom in to Bitcoin. We understand there's an SMT, so I'm going to take that out for Ethereum. And let's zoom into Bitcoin. What's the anatomy here? What's occurring with these 15-minute candles? What are we going to be observing? We're going to be observing that price closes and changes direction. Once it wicks above here, we're going to wait for a close beneath the previous candle, the body, and it does so. So this is the institutional order block right there. That 15-minute candle becomes your institutional order block. That's where the institutions placed their trade. After this high got taken out, that is where the institutional orders are at. Now, how can you use this? How can you utilize that? So we talked about how this can be an order block in the template earlier in the lecture. Then what does price do? Goes back into that order block. So wait for an entry on a retracement. Whenever a high or low gets purged, oftentimes you will see a retracement just like this on the higher time frame before there is a larger reversal. Now let's go to the 1 hour and you can observe price there as well. It's a lot easier to tell on the 1 hour. So we have that 15-minute order block, but now look at this 1 hour order block right here. Use the wicks, high gets taken out, price fails to close above the high, price then closes beneath 50% of the previous bullish candle. This becomes your institutional order block. So then what are you going to do? You're going to look to short above the close down here, and even more so 50% of the body. Anywhere here is an optimal area to enter your short. Why? Let me rephrase everything. There's an SMT on the high. The London session has started at 3 a.m. Institutional order block has formed. Price is changing direction and momentum with the open high low close concept. So now we're looking for a high probability short. And what type of return can we get from that? If we were to enter at the 50% area, right around there, with a stop slightly above the high, targeting the most major sell side liquidity pool, which is down there, that amazing return right there is what we can achieve. If you want to leave runners, even more so, all the way to this sell side liquidity pool down there. Notice price took that out before having a slight retracement. But so which candle now? We talked about this institutional order block. Then we talked about how these two candles gave you the opportunity to short. Now, which candle is the most important after that? And why? Pause the video, give it a minute. If you didn't pause the video, then you probably should, because it's, I think, really interesting for you to think about it before I actually show you. This candle right here. But why? Why is it so important? Well, if we are observing this as our institutional order block on the 1 hour time frame, we're going to want to see price close beneath that. Why is that important? Because that then becomes a change in the state of delivery. It's just closing beneath this order block. So if you're observing this and you're late in the game on all of this price action, do not be afraid, because you observed an SMT, you observed price completing the step-by-step process, and let's say you're observing price over here. Don't be afraid to short. It's still a valuable and optimal area to short. Now, you're not going to want to short down here and FOMO in, because then you're going to be red for a minute. Just use the same idea that we did beforehand for an entry up here. Observe the close, observe the open of the previous bearish candle, and you're going to want to short anywhere in here, not down here, okay? And you can still continue to catch trend. So this is the external high or low model. Now, if we were to go deeper into the rabbit hole, you would notice the timing of everything. So crypto is a great example, because we can observe the weekly session time models at any time with no discrepancies. From Sunday 5 p.m. to the following Sunday 5 p.m. Okay, then we observe Ash Wednesday right here. Aries, classic V-shaped recovery. Iscariot, classic fake out before I push back up, stalls out. Aries, and then Ash Wednesday. Remember what I talked about. Ash Wednesday, if you see time distortion, do not be afraid, because what can you expect for Icarus? Expansion. So notice the timing slightly after. Where is the root candle? Over here. Notice how everything is aligned, how everything just magically meshes together. Notice the timing of the reversal, the end of Ash Wednesday, and then it pushes back down further. So it's really beautiful when you combine time with turtle soup, and the type of entries you can achieve will seem almost impossible to everyone else. But this is a perfect example of external high or external low, and we talked about timing the move, the anatomy of price, where to place your stop, and how to confirm. I'm going to show you that one more time, how to confirm it's going to proceed further down once it closes beneath this candle here. The candle that wicked took out that high and caused that open high low close directional change. That becomes the order block, and once you see this candle, that's all it takes. After that, you can use any of these candles to continue catching the trend. Okay? If you're placing your short position, let's say you got here, place your stop above there. Let's say you got in here. Okay? Let's say you got a late move. Then you're not going to place your stop above that high right here. It's too tight. Where institution is not going to go anymore? Above 50% of this previous candle over here. So that area over here is completely safe. This high right there. That's where you're going to want to place your stop. Okay? Now let's look at an example for a 4-hour inefficiency. Let's say you're trying to catch a trend. You know price has been bullish for crypto. So you're going to look at your pairing of choice for the SMT, and you're simply going to look for very easy and basic opportunities too long. So you observe both charts. There was a slight SMT up here. Price is seeing a slight dip. But overall, price is bullish on the higher time frame. And even more so, there's relative equal highs that got formed on Ethereum up here. So what are we going to do? We're going to observe any inefficiencies that we can possibly long. There's some orders here that are getting filled on the 4 hour. Once price does that, we're going to look for an SMT. So right here is your SMT. The low got taken out on Bitcoin. At the same time, Ethereum did not take that low out. So there's a crack in correlation. There's a discrepancy in price. And because of that, we're going to look for an opportunity to long now. So if we observe the smaller time frames, we'll see the same exact concept that we just talked about. But now, instead of looking at an external high or low, so instead of looking at range-based liquidity, we're now observing inefficiency as our PD array of choice. Now we have the SMT. Then we include the aspect of time as well. Let me jump to the 1 hour chart. So we have Iscariot, Aries, Ash Wednesday, Icarus, not as volatile. We see that SMT form. We're observing the 15-minute chart now. We know the SMT is there on Ethereum. So which one are we going to want to take? Bitcoin, again, because it's the one that took the low out, so it's a better risk to reward opportunity. We're well below the root candle, which is way up here for Icarus. The next week begins Sunday, 5 p.m. But before we continue with that, let's observe the 1 hour. We zoom in. This was the 4 hour inefficiency that we're observing. This was the previous low right here. And then there's an SMT. Okay. But we're not going to, this is the tricky part. We're not going to be observing this low right here. Yes, there was an SMT here, but that's not the closest low that we're going to observe. Instead, we're going to be observing the low that's right here. This low. This is going to be your turtle soup right there. Again, we have the SMT, we have the higher time frame inefficiency, and just simply use, you see this intraday as well. So if you're scalping NASDAQ or S&P 500, we've even done this during some live sessions. So we look for specific candles at specific levels to form. Price takes the low out, closes back beneath. This candle then does what? Closes above 50% of this bearish candle. So where are you going to want to long? Anywhere down here, right? That's the, again, the retracement that price does. So this was the turtle soup. This is the retracement. Turtle soup. Retracement down. Institutions are then not going to take that low out because an SMT occurred, because it's the right time, because they hit a 4 hour inefficiency. And now price is changing direction again with the open high lows close. So this level is a protected intermediate term low. Okay. External low and internal low of this range here. So it's just doing a slight retracement. Institutions are then not going to take this out. So if you're trying to long, and you long maybe right here after price closes above it, you're looking for an opportunity for maybe buy side on the way up here. We drag it out, and you can be confident knowing that that low is not going to get taken out. Okay. See that? So again, we can just draw the next weekly session time model. And we can show Icarus. If you're late in the game, again, you can just use, not Icarus, we can show Iscariot. If you're late in the game, we can just use Iscariot. This is the root candle. Anywhere down there, you're going to want a long if you're looking for highs. Sorry, it's just really hilarious. Look at the time, the second interval. I'm going to take this box away. So at this time, what does price do? Expand. So strange timing, right? But that's essentially just turtle soup and the anatomy of it when it comes to the actual candles. And those are the two most basic models that you can get for market reversals. Some would call this this is very funny to me. Essentially this can be defined as many different things when it comes to price. Some will say there's an engineered buy side area here. There's an inversion right here. I'm going to long this inversion, and that's why the trade worked out. Some will say this was a higher time frame fair value gap, and I went long. Some will say this is a market maker buy model, and I went long. Some will say this is a reaccumulation for Wyckoff, and this was the spring right here. So I went long because there was a good amount of volume there. And some will say this is turtle soup, the secret to the market. But it's all the same thing. And if you just use open, high, low, close concepts, and you know what time to take the trade, and you look for SMT, it's pretty hard to lose, I'll be honest with you. And even if you do lose, you're managing risk accordingly. There should be no reason for you to blow an account up, that's what I'm saying. So you'll get many different readings. Maybe some will say there was a VWAP retest or something. There was an RSI divergence. But everyone alludes to the same thing. And that's just the aspect of time. There's time distortion for Icarus. So we talk about that all the time. It's just really funny. Like, come on. How more obvious can it get? There's the time distortion right there. What can you expect for Iscariot? Expansion. So I hope this turtle soup lecture gave more insight as to the two types of entries that you can achieve. And you can even do that intraday with intraday daily profile levels as well. So you can use the previous daily open, high, low, close. So previous day low, previous day high as a point of interest for an SMT. And that's it. I wish you the best of luck and God bless.